All right, let's talk about management accounting. So, financial accounting, I like to say, answers the question, how did you do? And managerial accounting answers the question, how are we doing? So, in managerial accounting, we're preparing reports primarily for insiders to help them plan, direct, and control our business. Whereas in financial accounting, we're making reports primarily for outsiders. The information that's in our reports for managerial accounting not only includes financial data, but it might also include physical data, like how many units are located at which particular stores or warehouses. The level of aggregation simply means what are we looking at? So when we send stuff out in financial accounting, we're sending it to outsiders and we're telling them about the company as a whole. Whereas internally, we'll have information about individual stores, individual outlets, individual distribution centers. We have to prepare our financial accounting in accordance with GAAP, generally accepted accounting rules. For managerial accounting, our reports are inside, and so we only have to prepare them so that they are understood by our insiders and hopefully don't mislead them. The information characteristics are that we have very specific rules about what gets included in our financial accounting. It has to be objective, reliable, consistent, and accurate. Whereas internally, we're just going to do the very best we can to provide the relevant information. There's no particular standards. Managerial accounting answers the question, how are we doing? So we're looking at the past, the present, to predict the future, whereas financial accounting, we were only looking at the past. And we're going to continually reporting under managerial accounting. Whereas financial accounting, it's going to take us a while to produce information. We may not have stuff until 90 days after the fiscal year end. In managerial accounting, we're going to spend a lot of time and energy trying to figure out what it costs to make our stuff. The first thing we'll do is we'll separate our product costs, the costs incurred inside the factory or at the job site, from the period costs, the costs that are going to get expensed right away. Our book likes to talk about upstream costs. Those are the design costs before the manufacturing process, and the downstream cost. That would be like the delivery costs, the costs of warranty, maintenance, and things like that after the goods have been manufactured and sold. But big picture, we're going to separate product costs from period costs. Product costs are going to stay on our inventory until we sell our manufactured goods, and then they become part of cost of goods sold, which is on the income statement. Period costs are going to get expensed right away. And this next part is hugely important. These are going to be our product costs, our direct materials, the stuff that we use to build our product. This is our labor cost. These are our direct labor costs, our folks that are working inside the factory. And this is our overhead, our indirect costs, like rent on the factory, like depreciation on our factory equipment. We're going to take materials, labor, and overhead, move it into work in process, take that material once we've finished working on it, and once we've converted it into something else, our final product, it's going to move into finished goods, and then it's going to finally hit the income statement under cost of goods sold. So as a manufacturer, we're going to have three kinds of inventory: the stuff we're going to work on, the stuff we're working on, and the stuff we're finished working on. Those are all balance sheet accounts, all inventory accounts. And then this cost of goods sold in red font here, that is finally an income statement account. Finally, all the dollars that we spent hit our income statement. And by the way, it's going to be real easy to figure out the cost of our direct materials, because we're going to have a system to keep track of how many board feet of wood went into our dining room tables this month. It's going to be easy to keep track of direct labor, because we're going to have our people fill out their time cards to tell us how many hours they worked on dining room tables versus dining room chairs. The challenge, and what we're going to spend a painful amount of time on, is figuring out how much overhead, how much indirect costs go into each dining room table, each dining room chair, each bicycle, each tricycle, each computer chip that we make. How do we know how much rent from the factory, how much depreciation on the factory equipment, how much of the janitor's salary go into each of these units? And we're going to spend a lot of time trying to make our best guess as to how to apply overhead. So remember, we're answering the question, how are we doing? We're helping management plan, direct, and control the business. And one of the things they're going to want to control is the amount of inventory. How much inventory should a company have? Just enough. Too little inventory and you won't be able to fill your customers' needs. Too much inventory and you're incurring extra costs like theft, damage, obsolescence. It's like paying for extra warehouse space, like insurance. So having extra inventory, surplus inventory, is an example of a non-value added activity. It doesn't add any value from the customer's point of view, and it costs us time and money. So we might institute a just-in-time inventory system where the inventory that we need is delivered just as we need it and to the place where we need it delivered to put it immediately into production. And there's a couple of big picture items that are going to color our study of managerial accounting. First of all, there's the triple bottom line: people, planet, and profit. We want to respect people when we're conducting our business. We want to treat our planet with love, and we still want to be profitable. It's great to respect people on the planet, but if we're not profitable, we won't be around very long to continue to do that. And management accountants have to behave in an ethical manner. We have to be competent. We have to maintain confidentiality. We have to be believable. We have to be credible when we perform our duties, and we have to maintain our integrity. Please don't think that these are just words. At some point during your career, you will be faced with some ethical dilemma where you're asked to do something that you just don't think is right. And it's up to you to make the right decision and do the next right thing. All right, that's an introduction to managerial accounting.